Welcome in, everyone. This is Thomas Talks on Thursday, a weekly live stream I do to talk about real estate or talk about the Des Moines area or anything else I find interesting. And one of the things that I've been finding interesting lately is investment specific loans. And I thought, who better to have on to talk about it than Jake Reed with Halo. Jake, how's your day going, man?
Good. I appreciate you having me on. Excited to talk about some stuff.
You were on a while ago. We were just kind of talking about first time homebuyer stuff in general, but for
Yeah.
people that didn't watch this live stream, you want to introduce yourself one more
Yeah,
time, kind of talk about where you came from, why you ended up deciding to get into mortgages, and talk about Halo Capital.
absolutely. My name is Jake Reed, like Thomas said, with Halo Capital, and we are a mortgage company, but we do things a little bit differently. We are a mortgage brokerage company. So instead of working for one mortgage lender, we are signed up with multiple mortgage lenders so we can kind of shop for a borrower specific situation. And it gives us access to a lot of things in the investment realm and things of that nature that, sometimes banks may or may not offer, including some, fix and flip stuff and some really fun tools if you really, really wanted to deep dive into it. So
Yeah.
I'm excited because a lot of these loan types, to be honest, I didn't even know existed until I got into wholesale lending. So I'm excited.
Yeah. Yeah. So for people that don't know, if you apply with Halo or any other mortgage broker, they're basically doing the mortgage shopping for you. If you go apply at your big national banks or your community credit unions, they are shopping the government products that are available, which Jake also has, and they're shopping their bank specific products. That is it. Jake is shopping the government products and any other private lenders that are out there that have products for him. So it's kind of like going to an insurance broker as well too. They're going to be able to get multiple products for you that might fit what you're looking for, and they have a lot of. Let's see what this looks like. Nope, that cuts Jake out. They have one of the first ones I wanted to talk about is a conventional investment product. This would be Jake. You probably have some of the lenders that you work with that offer conventional investment products. What are some of like the general guidelines when you're talking to people about? Let's start with someone that's in a fix and flip scenario. What are kind of the pros and cons of something like that?
Yeah, so a conventional investment loan is more what the normal is, right? So it's going to be, somewhere around a 20% down. Some lenders are 20% down, some are 25, some are even 30% down, depending on the property and borrower situation. But it is basically just like your conventional primary mortgage, just for an investment property. And you cannot, the big thing is figuring out what your qualifying income is. That second loan for that home is going to be on your personal credit report, just like your primary mortgage is. It's definitely a very useful product. And like I said, it's the normalcy that you kind of hear about. Uh,
Yeah.
and
And
it,
what
yeah,
will the for a conventional product, it's definitely based on your income or your flipping business's income. How do the rates compare to other investment products?
Yeah. So usually you're going to be 1 to 2 points higher on an investment product than a primary, just because, of course, the market, they want everybody to have a primary house. And investment loans are a little bit riskier. If you had a choice between foreclosing on your investment property or foreclosing on your primary, you're more than likely going to let the investment go.
Yeah.
Or you can't get a renter in there or something happens to the house, so they are a little bit riskier, so the terms aren't at quite as good, but the process is almost the exact same for a conventional investment as a conventional primary.
Yeah. It's literally just looking at your debt to income, your credit, and it's the
Correct.
same qualification process. Are any of like I don't know how much you've done like Are any of the more fix and focused ones more just focused on what the ARV of the investment property is?
Yeah. So on the conventional side, you really it gets tricky to use ARV.
Yeah.
There's much better products if you wanted to do sort of a fix and flip. Um, there's hard money products for that kind of a thing. There is also fix and flip loans out there that are a little bit higher interest rate, but you also don't have to do all the credit qualifying things that you do on a conventional side.
Because
So
they
what
know you're just buying it, you're fixing it up, and then you're immediately going to sell it.
Yep. So for the conventional investment side, what I would say it's best for is the person that has money saved away that wants to have equity in that property and you're looking to just get into your first investment property. Um, and you, like I said, you have the money socked away. You don't have any LLCs. You don't have any background. It's kind of for the normal person to buy a second property for an investment.
Okay. And I'm going to just get all over the place here. Is that product a lot like a product someone would be looking at for like a vacation home as well?
So that would be a second home, which is a little bit different. They're actually a little easier to get qualified. They're usually around 10% down payment.
Okay.
So, yep. Yeah, because they know that you're going to be paying for that second home. You're not going to rely on investment income for that home.
That's fair. Yeah. Okay.
So
Because that was going to be my follow-up question was why is that less stringent than an investment property? But that makes sense.
yeah,
So,
yeah, they 100% know that like you are going to be using that house. There's a whole lot of negatives. I mean, I'm sure that we all know somebody or have known somebody that's been in a bad rental situation, and those can get ugly quick, whether it's the landlord or the tenant's issue. But an investment property, you could be using potential investment income to even qualify.
Yeah.
So that's definitely why they're a little different.
Are there conventional products out there that not only give you a loan for the house, but they give you money to pay for the repair work?
Yes, there are some conventional flip kind of loans or that go off of the ARV, but the qualifications are so stringent and they're so property biased that it's really hard to deep dive into it. So what I would say is if you are looking to invest and get into an investment property and you have, a fix and flip situation or whatever, I would definitely get with Thomas and myself and we can deep dive into it and see exactly what might fit.
That is a disclaimer I should have put at the beginning of this video. This is going to be a very generalized overview because stuff like this, there's so many different products out there, and there's also quite a few different investment strategies. So it really depends on one, your reserves that you have, your know-how as far as are you going to be hiring a contractor to flip these properties or are you going to be flipping them yourselves? Because Jake, you can back me up on this too, is those ones that give you the money to rehab the home, they're going to want licensed contractors to be the ones flipping it. So if you're looking to get cash that you're going to take and just go use for materials, a lot of these products, that's just not going to work for you unless you happen to also be a licensed contractor. Correct?
Yep. 100% correct. And they want to see for those kind of fix and flip things, or even to use ARV, before you even get approved for the loan, they want to see draw schedules and bids and pictures and actual numbers on everything before they even qualify you.
Yeah.
So that's why it gets a little bit tricky. If the house is a $50,000 house that, you're going to have to sink $150,000 into and you're asking for a $200,000 loan, you could see why they get a little strict on wanting to make sure it is going to be a $200,000 home at the end.
Yeah. Yeah. And we've used the abbreviation a few times in a row. For people that don't know, ARV is after repair value. So that is the value that you think the home will be worth once this project is done. And I will also say too, a lot of people will use these types of investment loans to buy it, fix and flip, and then get it leased and then immediately refinance into a better loan product now that they have the lease in place as well.
Correct.
And one of those products that they might refinance into is a DSCR. Do you want to talk about that, Jake?
Yes, this is the main product that I didn't even know existed until I got into wholesale lending. How a DSCR loan works is it's a 20% down minimum. And basically, it's a no income qualification investment loan. They are looking strictly at the property. So, what that means is you order an appraisal just like normal. If there is a lease agreement in place, you may be able to use that lease agreement, depending on the situation, to set the market rent. If not, you order an extra rental schedule on your appraisal. Usually adds a couple $100 to that appraisal. It's called a 1007. And what that does is the appraiser actually goes and researches what the market rent is in that area, and they give it what is called a DSCR ratio. So if your payment, your principal, interest, taxes, and insurance are, let's say, $1,000 a month, and market rent is $1,000 a month, your DSCR ratio would be 1-to-1. So they look at that ratio more than anything, that you can rent this house out for exactly what the payment is. Now, the big thing that kind of changes that would be if the DSCR ratio goes negative or it goes positive. There are tons of different guidelines on tons of different products. So depending on what that DSCR ratio is, kind of dictates your loan terms.
Okay.
And then also the other big thing that I love about this product is you can close in your LLC's name.
Okay.
Your corporation name, or however, your business is set up, which
because other than they're basically just looking at your credit, right?
Yep.
As far as your personal stuff, they just want to know, do you have enough assets to cover the down payment? And do you have enough credit score that we could trust you with a loan type like this? Other than that, it's basically all on the proproperty that you find, correct?
Yep. And that is why they require at least a 20% down payment, because how the investors kind of see this is they have 20% equity if they had to foreclose, and they can rent it out for the amount that is owed on it.
Yeah. And I will say too, like, just because I get bored and I try to do the math with this on homes that are currently on the market, it would be really hard to make the math work if you're putting 10 or 5% down. So, yeah, to be totally honest, like, because what ratio are they typically looking for?
Anything over 1-to-1 is definitely beneficial. When you start going negative, the loan terms start getting a little steep.
Yeah.
But, just because that 1007 says it's worth $1,000 a month, if you're an experienced renter for sure, and you know that you can get $1,400 a month, you may not care about that little bit worse loan term because you know that you're going to get more in rent for it.
Yeah.
And they usually, with rental income and things of that nature, there's a certain percentage that underwriters use, which is kind of lender specific. Some use 75%, some use 80%. And that's just to show basically if you ever had a place where a tenant isn't there, it's building in for that. So they only let you qualify with that certain percentage.
Yeah. A 1.1 is definitely possible in our market, but it's not like every house you see listed is going to fit that requirement. It takes a little bit of looking, but it's definitely possible to find homes like this. Both Jake and I know people that have purchased properties with DSCR loans, and they exist in our market. And a lot of people that that have multiple rental properties, this is probably one of the main ones that they're using. So.
Or, one of the things that I wish that I would have done, my first house in Norwalk there over by the elementary school, what I wish I would have done is transferred that into an investment property.
Mm-hmm.
And bought my new primary and then refinanced that property into a DSCR loan.
Yeah.
And
Yeah.
that way I could have, gotten it off of my personal credit and stuff like that. But the ratio, because my payment, and granted, this was a long time ago when I bought it, but my house payment on that house was only $800 a month.
And it would have easily rented for 12 or 13 probably, right?
Right. So that ratio would have been awesome.
Yeah.
So it would have been truly the perfect opportunity. So when people are buying and selling, if you don't necessarily have to sell, it might be a situation that you look into where,
Mhm.
you just move that into an investment property, buy your new primary, and then we look at refinancing your existing property into a DSCR loan.
And you
And
could probably cash out refinance on the DSCR as well, can't you?
yes, up to lender discretion. Some go to 70, some go to 75.
Yeah. So if you're in a situation where there's quite a bit of equity in the house, you're going to turn it into a rental and you want some of that equity, it's just definitely something that you could pull off.
Yep.
Yeah, this would be for sure one that is probably the easiest to get started. There's a unique situation, but I feel like it should be pointed out to people because I know quite a bit of people that are in situations where they're in a house that they're going to be living in, but it has a ton of equity and they don't know for sure like if there's anything creative they could do with the equity. And I think a HELOC would be a decent option. And you could talk to me about this, Jake. I know you would have to get a pretty specific HELOC that lets you use the HELOC to purchase another property, wouldn't you?
So really, when you pull out a HELOC, the lenders do not care what you use that money for. The thing is you have to figure out with your lender if you can qualify for your new home, whether it be a new primary, new investment, whatever it is, with that HELOC payment. So
Okay.
that payment will count against you in your debt to income ratio. Like me, myself, I have a HELOC on my primary, and I used it to rebuild and restore an old truck. Just because I knew that I could get an auto loan, but the HELOC terms were a lot better and amortized a lot longer. And also, a HELOC is a line of credit. So it's a home equity line of credit is what HELOC stands for. So you're only making a payment on what you pull out.
Right.
So I have, let's say you have $100,000 worth of equity. They let you go up to a 90% loan to value. So you can pull up to 90,000 of that. So you have access to that money, but you don't have to use it, and you're not making a payment on it unless you've used it.
Yeah. I think it's something interesting, like not even just on the investment side of things. I know plenty of people that got them back when interest rates were really low because it's a better emergency fund to have than your credit card. Because I mean, do you want to talk about how interest rates on HELOCs generally compared to like just a conventional mortgage? Like how many points are they normally above like just a normal primary residence mortgage?
Yeah. So HELOCs are typically like 2 to 4 points higher.
Yeah.
The important thing to remember about HELOCs is because they are amortized over 30 years, they work almost the same as your mortgage loan. So the first 7 to 10 years of that amortization, if you only make the minimum payment, is paying a lot of interest and not a lot of principal.
Okay.
So your biggest thing to think about when you have a HELOC is what is that minimum interest every month, and then how much can you dedicate towards principal.
Yeah.
Same premise with like paying down credit cards. Your minimum payment may only be $100, but 70 of that's going to interest and 30 is going to principal.
Right. Right.
So
But yeah,
it's a good slush fund.
yeah, yeah. And getting one, I mean, 8 or 9% is quite a bit better than any credit card that you can find out there.
Yeah.
So
Yeah. And sometimes car loans, if you're, I know people that have gotten HELOCs when like their engine blows in their car and they still owe $15,000 on it and they don't know what they're going to do. Well, you have equity in your house, that you can use. And not everybody realizes this, but the equity isn't just what you've paid. Your house is appreciating every year.
Mm-hmm.
So if you bought a house 10 years ago for $200,000, you may have $50,000 worth of equity just because you own it.
Yeah.
Not just what you've paid down. So and some HELOCs require appraisals, some don't. I think it mostly depends on what kind of an LTV or a loan to value ratio you want to go to. Obviously, the higher the loan to value, the more that they're going to want to make sure that that house will appraise for that. But if you're just needing, something to reprieve you from those credit cards or car loans, or you want to get into investments, it's definitely an awesome product to look into.
Yep. As long as you're making more money than the interest they're charging us.
Yeah. I mean, worst comes to worst, you're paying on it for 30 years, just like your mortgage payment. So, if your HELOC payment is $300 a month, just realize that that's $300 a month until your mortgage is satisfied.
Yeah.
Or if you go to refinance, you have to see if that HELOC can be subordinated, which basically means that it gets put in second lien position when you refinance. So that's another thing to kind of consider when you're getting a HELOC. And any lender out there can kind of judge whether a HELOC is best for you or a cash out refinance would be best for you. Or, maybe you just do a rate and term refinance and get that rate lowered at this time and then pull the HELOC out. So you're not touching that primary loan.
Yeah. Yeah.
Especially like the people that bought during COVID and have 3% rates and don't want to do a cash out refi. Why not look into a HELOC?
Yeah. Yeah. Just to take care. Like, people always talk to me about, or one of the common criticisms I will see is like, congrats, you paid $180,000 for your house and now it's worth 300. You're not going to see any of that until you sell it. And this is a product that I point out to people. It's right here. Like this is how you can see it before you sell it. And it's one of the better loan products out there. If you're in a situation where you have enough equity where you would be able to buy an investment property with it, it's a great thing for that. It's if the crazy situation comes up with a car, like Jake said, or crazy situation comes up with your house and you just don't have the cash to get that project done. That's why all the equity is there. You can make that big improvement to your house and just use your equity. And as long as you're going to be able to pay it off, if you're improving your house in a way, it's going to get more valuable when you're putting money into it too. So it's a really just an awesome product that I want people to know about and think about. This last one that we're going to talk about is a little trickier to pull off, but I do think it is a product that not a lot of buyers know about. And I go see houses every week, and I see houses that this wouldn't be a terrible fit, but you would need the right team to kind of pull this off. Do you want to talk about FHA 203K and how this product typically works? This is not technically an investment loan, but it is a great loan to use if you're looking at purchasing a house that needs a lot of work.
Yeah. So, like Thomas said, there's a lot of houses out there, especially in, the older Des Moines areas that have just been kind of, not taken care of the way that they should be. And quite honestly, you may not be able to get a conventional or a government loan, a normal one on just because of the property shape. So that's where the FHA 203K comes in. Now, this is a government-backed loan. The biggest thing that I like to tell people with FHA 203Ks is get with a contractor first. See what those repairs are going to look like. Because once you're under contract and figuring those things out, you may not want to do the deal anymore. So do your research before you actually are looking into getting it under contract. Obviously, there's some factors to that. if it's going to sell quickly or something like that, we can work around that. But the big thing is this is an after improved value kind of a loan. So you get an appraisal up front for what the house is worth now. And that appraiser also looks into comparables and all of those things to get an idea of what the after improved value is going to be once that house is fixed. Now that gap kind of sets your financing. And then your contractor has to see if he can fit his budget into that gap. So let's say that you're buying a house for $100,000 and the appraiser thinks that it's going to be worth $250 after, you put all the improvements into it. If your contractor comes in and says, hey, it's going to be $150,000 for us to fix it, then it's probably not going to work. But if your contractor can come in at $100,000 and still leave you with $50,000 in equity, as long as those numbers stay correct, then it's an awesome product to look into. The underwriters like to see things like draw schedules, because your contractor will get paid as the project gets done, not just as completed. So let's say that the house needs new windows. The contractor submits a form. They send it into the lender. The lender sends them the money for the windows. They show them when it's been completed. They get paid for the window completion.
Yeah.
So it's kind of like, you get paid for the raw material and then you get paid for your labor kind of a secondary. And that happens throughout the entire process.
Yeah. What does the down payment normally look like for products like this?
It really depends on the borrower's qualifications. I haven't looked into specific lender scenarios on a 203K, but I would say, anything around 10%.
Okay.
Depending on lender specifications. Some may be a little bit riskier and may, go to 5. And then some may be a little bit more conservative and say 15. So
you would need a little bit more cash than FHA's typical product.
Yep. But remember that equity portion may be there as well for that down payment.
Oh, that could count towards the down payment?
Yep. So, it's all about not a down payment, but a max loan to value.
Yeah.
So if the valuation is there,
and then
that's kind of how it works.
That after repair value that the appraiser is trying to determine, is that something where you tell them what you're thinking about doing before they do that appraisal?
So what they look at is the homes in the area. So it's more about comparison than it is the actual house. So they look at the entire neighborhood and maybe even city, depending on what their radius is. And they say houses, if it's a ranch style house, 1,800 square foot, what are 1,800 square foot ranches selling for that are in updated condition?
Yeah. Yeah.
So they're assuming that you're going to bring it completely up to where it's in the comparable range.
Yeah. Yeah. And then is there any conventional products that you guys have that compare to something like this?
There's a few, but like I said, their qualifications are so hard to come up with because FHA is government backed and not privately backed. It's a little bit easier.
Okay.
So those that are looking conventional, and especially if it's like small fixes or something like that, you may be able to get into a fix and flip loan that's a little bit higher interest, but then refinance it into a conventional once it's fixed. Or look into a hard money loan, because there are many lenders out there that'll do that hard money loan for the fix and flip. But you have to understand when you're talking about those things that, the interest rate reflects the risk.
Yeah.
So, people think about mortgage rates. They're like, 6-7% is very high. Well, on some of these fix and flip products, you may be looking at, 12% interest or 13% interest.
And the goal is to not carry something like that for 30 years.
Yep. They're very short term. So they know you're not going to hold on to that for very long. So they're trying to make as much money as possible on their money in that short period of time.
Yeah. Yeah. And that's a really good goal to keep in mind. I'm trying to think. There was so with the other thing that's kind of tough to pull off with these is obviously none of the work is going to start until the loan has closed and the property is officially yours. Do you know, are the payment schedules on these exactly the same as any other primary home, or do you start paying once the work is actually done?
That is a good question. It's sometimes lender specific. So sometimes the lender will have interest only payments until that is done. Some places offer that. Some places just start your mortgage just like normal while it's getting fixed. Some have like a grace period. They say, hey, your payments aren't going to start until this date. It's all about the product selection. And that's what Thomas was saying, that this is such a high level overview, is because I don't want to tell everybody something.
Right.
Like, hey, yeah, you could do this for this. And then you find a property and you can't.
Yeah.
Because of something, very stupid.
Talk to us before you offer on anything.
Yeah.
Because that's one of the other things I was talking about, though, that it is kind of tough to pull off. Like, even if this is your upgraded home, you found a old farm home that's in a beautiful acreage location, and you're like, I want to fix this up. I want to go FHA 203K. Well, there's a chance that you're going to have to be making payments on it when you're not even living in it, which means you're living somewhere else and you're also making a payment on that. And it's tough to pull off that way. You have to have, and I do, and I'm sure Jake does know people as well too. You have to have a pretty good relationship with a contractor as well, because you have to get bids. You have to get a contractor that's willing to work with this loan and provide the information that they need. It's not as simple as having someone show up and saying, yes, I'll do this project for you. It's, can you do it in a timely manner? Can you get this information to the people that need it, and do the extra legwork and do it somewhat quickly? And finding contractors that do all that is kind of hard. So it is something that's hard to pull off, but it is an option for the dreamer out there that's kind of looking for the diamond in the rough. Well, take that home that needs a lot of work and turn it into that diamond in the rough, So
yeah, and making sure that the contractor does things the way that you want them done.
Yeah.
We all know somebody that's been, kind of jerked around by some kind of a contractor. You say, hey, I want windows, and you have that in your agreement, and they come back and say, hey, we didn't have windows in our agreement. We're out of money. Well, now we're kind of screwed, because your after improved value is counting those windows in.
Yeah.
So
you need to get them done.
Yeah, getting with a really good contractor, especially one that's worked with this kind of a loan type before, because like I said, those draw schedules, if they pay somebody to do flooring, say the general contractor doesn't do flooring, they subcontract that, the contractor has to pay the flooring guy.
Yeah.
And then they may not be able to submit for a draw until that flooring is completed. So they may have to float some of that money in the meantime. So making sure that they understand the process and aren't getting gruff with you in the middle of it is the big thing.
Yeah.
And, familiarizing yourself with the construction process during that to make sure that the loan that you got equals your dream home.
Yeah, of course. Cool. I didn't make a slide for it really quick, and this isn't necessarily something that you guys offer because would be through a private party. But do you want to? I mean, you've kind of mentioned it a few times. Do you want to talk about hard money?
Yeah. So there's lenders out there that are hard money lenders. So basically, what that means is they are not backed by any government or private entity. It's just basically somebody's private money.
Yeah, it's like a fund most of the time. Yeah.
A lot of times it's like an investment group that has pooled together a certain amount of money, and they have like a board or something like that makes decisions. Just know that if you want to go that route, it is a little bit higher interest rate because they are shorter term loans. So let's say you buy a house and you need 25,000 to fix it. You may be able to go a hard money lender at 15% for 6 months, and it'd be a lot easier than doing an FHA 203K. Just because there's not the draw schedules, you have the money in your hand, you're controlling it. Or if you don't want to work with a contractor at all, and you're just kind of a handyman and want to fix the house yourself, because no government-backed loan or regular agency loan, conventional Fannie, Freddie, government, any of that is going to let you make those repairs on your own, unless you're a licensed contractor.
Yeah.
So, you may know how to do electrical and you may be the best person in the entire state at doing it. But if you're not licensed to do it, then they won't let you.
Yeah. Yeah.
So then you can look into those kinds of things, or even the HELOCs, if you just need short-term money to do that. And then you can refinance once you get that work done, or however that looks. But there's those products, and then there's true fix and flip products. One thing with FHA is title seasoning. So if you want to buy a house, fix it, and then sell it, you have to be on title for a minimum of 6 months with FHA before you can sell. So if you think you can get the work done in a month and then you want to flip it in 4, you can't sell it yet.
You can't sell it to an FHA buyer.
Yep. So now you're looking at, flipping rules and everything else on even conventional mortgages. So if you are just looking to do a true fix and flip where you think you can get it done quick and get it sold, then those loans are a great option. And they run on basically the same process as an FHA 203K, just not with the FHA backed.
Yeah.
So they are a true, here's a check, go do it. Here's a check, go do it, Yeah.
I think the biggest thing, and that I kind of wanted to do this video just to get people out there starting to kind of think about it. And if you want to have a deeper conversation, reach out to us. But I hope some of these products are kind of getting your wheels spinning, thinking, I want to buy a flip home that is listed at 170. I don't have all the cash to do that. There are products out there that can help save you some of that cash and do it for less cash, and then either sell it, or what I think is a better strategy, hold it and turn it into a rental.
100%.
Flipping it's a lot more like gambling than a rental is. Not saying that you're not taking a risk with a rental property, but flipping is a trickier thing than finding rentals. But there's lots of products out there. Jake and I are more than happy to talk to you guys about it and talk about the best way to get started. There's tons of different products out there.
One other thing I wanted to bring up is there's short-term and long-term rentals as well.
Yeah, I forgot to ask you that. With the DSCR, have they changed that so you can include project out short-term rental?
You can with history most of the time.
Okay.
So whether you have history of doing like Airbnbs or VRBOs, or if the property has history of it, it's just another risk layer. So it's one of those things that picking the correct lender is a big thing for. But if you wanted to buy a house for a short-term rental, and especially because DSCR is really looking at that market rent, how you make your payment, they're not as worried about.
So you could, as long as it qualifies for the long-term rent schedule, you could buy it with that DSCR product and have it be a short-term rental.
Yes, depending on the product. You just have to make sure that specific DSCR product, as long as they are okay with it being a short-term rental, just because if you get into a DSCR product that doesn't allow short-term rentals, if they see it on Airbnb in 2 weeks, they may call the note due, and then you're really screwed. So it's one of those things that you definitely want to divulge that information when you're talking with your LO and your real estate agent. That way they can make sure that specific product isn't going to hurt you in that way. Because there's, DSCRs are almost a commercial loan. So say you wanted to buy a place in Florida and you wanted to spend a month there a year and then VRBO it the rest of the time, or, do one of those kinds of a thing. There's definitely loan products for that in that DSCR space.
And those DSCRs, you got my wheel spinning now too. You could get that for duplex or a quadplex too, correct?
Yes.
Yeah, and the numbers start to work out a lot better if you're looking at that than just a single family home as well too.
Yep.
So just need to figure out a way to get that cash, and then
Yeah, that's the big thing. People ask me all the time. They're like, "How do you get into an investment?" Well, the big thing is making sure that you have enough down payment funds. So really start saving that money or figuring out how you can use equity to make equity. Kind of like the HELOC that we were talking about. Use that equity in your primary house to build equity in another house.
Mm-hmm.
Look into doing all of those things. And since like a DSCR is a no income loan, that HELOC doesn't hurt you.
Yeah.
And being able to close in that LLC, I'm not a lawyer by any means, but it may change things with liability and things of that nature, and taxes and how you can do tax deductions on rental properties. Opens up a lot of doors that way.
Yeah, of course. Well, hey, thank you, Jake, for coming on and talking about this. And I know you're kind of got to get out of there right now. So thank you so much. And thank you to anyone that's watching. If there's any follow-up questions, don't be afraid to message me and we can get that sit down. Or if it's just a question in general, I will make sure to cover it on a future episode. Have a great day, guys.
Thanks, guys.